بسم الله الرحمن الرحيم. الحمد لله والصلاة والسلام على نبينا محمد وعلى آله وصحبه أجمعين. Assalamu alaikum wa rahmatullahi wa barakatuh. Welcome to lecture 19. Today's topic is a short-term financial planning. Okay, in the previous lecture we focused on long-term financial planning. So today we will talk about short-term financial planning inshallah. So short-term financial planning, it focuses on the managing current assets and liability, right? What do you mean by current assets, which you think are a short-term assets? Like for example, stock. That assets will not be in your books for more than 12 months. And what is the short-term liability? And it's any liability that you will pay off before 12 months, right? This chapter basically focused on everything which is related to short-term financial planning within 1 year plan. So managers evaluate their business circumstances to determine how much working capital they need, and they implement different strategies to do that, right? So which is why like short-term financial planning is very important. So essentially, how much cash do we have in the business? Do we have access cash in the business, or do we have a very small amount of cash in the business? If there's excess cash, then what do we do with it? If there any shortage of finance, then what do we do with it? Okay, short-term financing needs are tied to the firm's long-term decisions. So when we say short-term, it means less than 1 year. So the financing needs for the company within the year for only 1 year. This is also related to the firm's long decisions, and actually we'll see this one during this lecture inshallah. Okay, before we start, we have here one concept called total capital requirement. Total capital requirement is the total cost of the assets that a firm needs to run efficiently. So in order for the company to work to run, we need some assets, right? Like we need for example some money invested in planet, in machines, some money to invest in inventory to buy inventories, or some of them in account receivable. We call it capital requirement, which means how much capital of our fund we need to have in order to run the company, the day-to-day operations. So here our focus on short-term planning on day-to-day operation, day-to-day decisions, not the long run. Let's start with this graph. So what do we have here? The graph above illustrates or shows the growth in the firm's capital requirements. The line is upward sloping. You can see the line is going up, right? Which means as the business grows, it is likely to need additional fixed assets and current assets. So what's the idea here? On the y-axis, we have how much we need capital, total capital requirement, how much money we need. So over time, the company grow. All companies, they grow over time. And because they grow, you can see the black line. This is upward sloping. It's going up because they grow. Definitely they need money, right? They need more assets. They need more fixed assets or long-term assets. And they need also more current assets. So as the business grows, it's likely to need additional fixed assets and current assets. And today we will focus on current assets inshallah. Okay, now there are three approaches or strategies to manage the short-term financing. The first strategy called relax strategy. What does this mean? This means the firm or the company has a permanent short-term cash surplus, and this surplus or extra or addition will likely to be invested in marketable securities. To understand this one, we have the graph. What do we have here? You see the black line? This is your long-term financing. When like we say long-term financing, it means like example, you have a loan for more than 1 year. That's why it's long-term financing. The orange line, this is how much you need money for the current period for short term. Okay, so the orange line is requirement. Okay, this is how much you need. It's up and down, depends on the seasons, right? Some seasons you need more money, some seasons you need less money. For example, if you are an ice cream company, okay, during the winter you don't need too much inventory, right? During the summer you need higher level of inventories. That's why this line is not straight. It depends on the business cycle, depends on the seasons. So this is how much we need. This is the orange line. At the top, the black line, this is how you finance your needs. Okay, so the first approach here, we use the long-term financing to finance our short activities or short-term requirement. If you use this method or this strategy, this is, we call it relax strategy. So the firm will have always extra cash. This is why the line, this black line is above the orange line. Always you have more than what you need. Like for example, you need this amount of cash here in the green point in the orange line, but you have in the black line a higher amount, right? We call it relaxed because the company is relaxed. They have more cash than what they need. So this is a first strategy. The second strategy is called restrictive policy. This strategy is the opposite of the previous one. So the firm has a permanent need for short-term borrowing. Now you can see the black line and the orange line. The orange line is how much you need, right? We need, for example, if you add the green point in the orange line, you need this amount of money. You need this amount of capital. But at the bottom, the black line, the company like will only use this amount of money or only finance their activity with this amount. We call it restrictive. We are very restrictive. Okay, they don't have any extra. Actually, they have some shortage here in this period, right? So this black line is your long-term financing. You take, for example, a loan at this level, but actually you need more than whatever you take. So you took this level, but you need more. In this case, always the company will have a shortage and they will apply for short-term borrowing. Okay, they will apply for short-term loans. So this graph is opposite of the previous graph that you have there. Actually, there you have higher amount of money, which is opposite of this graph. The third one, the middle of the road policy. So from the name, this will be in the middle. Okay, we don't have too much cash and we don't have too much shortage. It's in between. So the firm has spare cash that I can lend out during the part of the year when the capital requirements are low, and the firm can borrow during the rest of the year when the capital requirements are higher. So here the company, they follow a strategy where sometimes they have a spare cash or extra cash. In our previous example, I said if you are an ice cream company during the winter, you don't have too much inventory or too much cash to run the company, right? So during that period, you will have a cash surplus because you are not using your cash to buy inventory. You will have a spare cash. You can use it or you can lend it. Okay, give it to someone or put it in the bank. This is during the low period. Okay, now in the summer you will have actually higher amount. You need more cash to run the company, right? In this case, you can borrow. When the capital requirement is high, you can borrow money. So that's why the black line is coming in the middle. Sometimes you have less cash than what you need. Sometimes we have higher cash than what we need. Okay, this is the third strategy. We call it middle of the road policy. Managers typically list three considerations when determining the best mix of short-term and long-term financing. So when we finance our activities, normally we rely on a mix of short-term and long-term financing. So we don't take only long-term financing more than 1 year, not only short-term. It's a mix of short and long, and to determine what is the best mix. There are three categories or three requirements that determine what is the best mix for the company. The first one, matching maturities. So if you have a long-term investment, definitely you need to apply for long-term financing. You can take a loan with more than 1 year if your investment like it's for 10 years, you must apply for a loan for 10 years just to match the maturity. If your investment is 5 years, you apply for 5 years, and so on. If your investment is less than 1 year, you can use a loan with less than 1 year. You need to match or with the maturity. Okay. Another consideration is the working capital. How much current assets, how much current liability you need to have in the company. The last one, the advantage of liquidity, which means, do you want to have extra money? Do you want to enjoy the liquidity of the company? You have extra money in case something happened or not. This we call it liquidity, and we will explain it actually in the next slide, inshallah. What is liquidity? Some firms choose to hold more liquidity than others. Okay, some firms, they like to have more liquidity, more money, and more cash surplus. Other companies, they want to have less liquidity, and we will learn later on, inshallah. There will be a trade-off between having too much liquidity and between your return. Okay. The questions: why do many high-tech companies hold a huge amount of short-term securities while manufacturers like steel's company, they hold much similar reserves? For high-tech companies, they hold too much short-term securities or short-term bonds because it's easy to sell it in case we need money or in case we need extra cash. So those companies, from the name, okay, they are high-tech. They have a higher growth. If they need any extra money, they can easily sell the short-term security and finance their activities. On the other hand, for the manufacturers firm like steels, normally they know what is the demand. So the demand on steels will be stable. So they don't need to have too much reserves. Okay, this is the explanation for this question. Now, the next question is, what are the costs associated with holding excess cash? First of all, excess cash lowers your return on assets. You could invest the excess cash and generate more return, and instead of just holding it, right? If the company, for example, need 1 million cash and they are holding 5 million cash, this is a waste of money, correct? They could invest the 5 million in different investment. Why you are just keep it in the bank account? Okay, so this is one cost of holding cash. You are not generating income from those cash. The second one, holding excess cash or too much cash increase the managerial slack. So the manager or the managerial or the management of the company, they could use it for their own profit or their own interest. Like for example, they could fly using a private jet or business class using the company access cash. Okay, so it's not good to have too much cash in the company. You need always to tie that to some investment. Now let's talk about working capital, components of working capital. So when we say working capital, here we are talking about current assets and current liability. From the name, current assets, those assets with a life of less than 1 year. Current liability, those liability that need to be repaid within 1 year. So this is when we say working capital. Now normally we calculate this formula that I highlighted in yellow color, net working capital, from the name. Okay, net working capital, it's equal to current assets minus current liabilities, and this will give you a net working capital. Let's take this example. What will be the change in net working capital if the current assets increase by 170,000 and current liability decrease by 60,000? The questions: what is networking? Networking is equal to current assets minus current liability. So current assets is 170, which is given in the questions, minus current liability decreased, which mean another minus, right? So minus minus will be positive. The answer is $230,000. This is the net working capital. Here we have some examples of current assets. Students, they should know this one actually from first semester. Okay, common current assets. We have account receivable, and under account receivable we can actually divide it into types: trade credit or consumer credit. Trade credit, if our company sold some products, let's say to another company on a credit, not cash, on a credit, this we call it trade credit. And we say consumer credit if our company sold the products to retail customers like me and you, I mean to other consumers. Okay, so account receivable means sales on credit. Okay, you sell something without using the money. This one we call it account receivable, and this is the first item, or one of the item under the current assets. Then we have inventory. Okay, this is also part of the current assets. And when we say inventory, we are talking about raw materials, work in progress or in process, and finished goods. Okay, then we have cash and marketable securities. Cash is cash, we know this is the most liquid one, right? Marketable securities, the same, it's another part of bonds like treasury bills and other things, so we call it marketable securities. Some examples of cash: we have demand deposit. If you have a deposit in the bank, you have another type called time deposit, or commercial bills or treasury bills. There are examples of cash and marketable securities. Okay, so we're done with the current assets. Mainly you have account receivable, inventory, cash, and marketable securities. Current liability: under current liability we have account payable and short-term borrowing. Account payable, this is basically if our company purchased some raw material or inventory on a credit, we call it account payable. So this is a purchase on whatever on a credit. Short-term borrowing, example, if you took a loan for less than 1 year, this is a short-term borrowing. Done with working capital, which is basically current assets and current liability. Now we will move to another topic called cash conversion cycle, CCC, which is important. CCC, or cash conversion cycle, measure how many days it takes a company to receive cash from a customer from its initial cash outlay for inventory. Okay, it measures how many days, so always when we calculate the CCC, the answer will be in days. Okay, this will tell you how many days it took or takes a company to receive the cash from the customer, from the time they sell or from the time they buy the inventory to time they collect the cash from the customer. So this is a cycle. Let's explain this cycle. This is a simple cycle for operations. Essentially what's happening in the business, what's happening is that you have some money, right? You have some cash with you to use that cash, right? So basically the company will buy raw materials and inventory. So the company will spend cash here, right? Then they will convert it to finished goods or inventory. So assume here they bought raw materials. Okay, they put it in the machines, they produce a product, then they sell the product to the customers. Now normally they sell it on a credit, okay, not cash. So here we have account receivables. Then the customer, after a few months or a few days, they will pay the cash to them. So this is what happened in the business. Okay, this cycle we call it cash conversion cycle, like from the business, okay, operation perspective. So here we are interested to know how long does it take for the company to collect the cash from the time they spend the cash on raw material to the time they receive the cash from their customers. If we have to calculate a period, then how we do it? How much time are we going to convert our cash back into cash? So you will use your money to buy some inventory, so that inventory will stay with you for some time. Then when you sell it, you will have to wait for the customers to give you your money back. So that is the total time. And then you will also take time to pay to your suppliers, which is your reduce, right? So ultimately, the net time, which is the left, is known as the cash conversion cycle. So basically, it says the longer the protection process, it seems the more time it's used. The money is tied up in the inventory. And if the customers also take a lot of time to make your payments, then also it is all tied up. But like for example, if you have to make your payments to the vendors quickly, and if it is short, that means you need urgent money for it. But if you also get some credit from your vendors, then that means that gives you additional time, right? Okay, you can see the formula of cash conversion cycle equal inventory period plus receivables period minus account payable period. Okay, so always normally they are given. If they are not given, there are some formulas to calculate each component of cash conversion cycle. Actually, we need those ratio. If you see inventory period in the formula, actually it is here. It's equal to inventory divided by annual cost of goods sold divided by 365. For account receivable, period from the name, okay, you need account receivable at the top divided by annual sales divided by 365. Account payable, it's equal to account payable divided by annual cost of goods sold divided by 365. Now, why we need those ratio? We need it to include it here, right, in the formula, in this formula, to calculate the cash conversion cycle. Okay, so it is important to know them. We have one example here. The question is, what is the cash conversion cycle for a firm with a 3 million average inventories, 1.5 million average account payable, receivable of 40 days, and cost of goods sold 18 million? The question is, what is the CCC, cash conversion cycle? This is a formula from the previous slide that I highlighted in a green color. So now we need to calculate each of them. The first one called inventory period. Okay, so what is the definition here? Inventory period equal to inventory divided by annual cost of goods sold by 365. Okay, inventory is given in the questions is 3 million. We put it in the top divided by cost of goods sold. It is given 18 million divided by 365. So the first part done, plus receivable period. They are given, right? It is given in this questions 40 days. So this is easy, no need to calculate the ratio. It is given as number of days. Okay, account payable from the formula. Okay, you need the payable divide by cost of goods sold by 365, which is here in the questions. 1.5 million divide by cost of goods divide by 365. So the answer is 70.42 days. Okay, so the cash conversion cycle is 70 days almost. So which means it takes the company 70 days from the time they spend the money to buy the inventory to the time they collect the cash from their customers. Okay, now let's talk about the working capital trade-off. Working capital can be actively managed. It's not set in stone. So working capital is flexible. You can manage it. There is some carrying cost and some shortage cost. Carrying cost means cost of maintaining current assets, including the opportunity cost of capital. What are some carrying costs associated with the holding inventory? Yeah, if you hold too much inventory, definitely this will cost you money because you need to store them, right? You need to rent some stores to store your inventory, and this will cost you money. Sometimes you need put some securities, right, on your inventory. This also will cost you extra money. So the idea, if you hold too much working capital, this is not good. There will be some extra cost. On other hand, if you have less inventory, this also will cost you some profit. If you have some shortage, then you may lose your customers, right? They come to buy and they couldn't find the inventory. You may lose them, right? So costs incurred from shortage in the current assets will be, for example, the reputation's cost. So you may lose your customer, you may lose some profit. Here we have some examples about change and working capital. So how would the following affect cash and network capital? The first one, the firm repurchase outstanding shares of the stock. If the firm repurchase their own shares, so sometimes the firm they repurchase their own shares. We call it treasury stock. In this case, what will happen? Both cash and net working capital will decrease, right? Because you are using some money, some cash to buy shares. Definitely this will reduce your cash and this will reduce your net working capital because cash is part of working capital, part of current assets. If the firm use cash on hand to buy raw materials, what will happen? Think of this one. They use the cash to buy raw materials, which means cash will decrease because they use it, right? They spend it, so cash will decrease. Now, net working capital will not be affected, correct? You have less cash, but at the same time, you have more inventory. And both of them related to the current assets. Inventory and cash is the current assets. So the total effect on net working capital will be unaffected. The firm sells long-term bonds and puts the proceeds in its bank account. So they sell some bonds and they put the cash in the bank account. Cash will increase, working capital will increase. Okay, now let's talk about another topic called cash budgeting. We need to follow always 3 steps to preparing a cash budget. First of all, forecast the sources of cash, then forecast the uses of cash, and at the end we will calculate whether we have a cash shortage or surplus. It is very simple. You need the sources of cash from where you get the cash, the uses of the cash, where do you spend the cash. Then at the end we will know whether we will have a shortage or surplus. So the financial plan gives the strategies for investing the cash surplus or financing any deficit. So once we know we have a surplus or shortage, we know what action we need to do. If you have a surplus, you can invest it. If you have a deficit, you need to apply for a loan or short-term financing. Okay, sources of cash. Ending accounting receivable will equal beginning accounting receivable plus sales minus collections. This will give you the ending accounting receivable. Okay, example. What was the sales volume in the current quarter? If the beginning account receivable is given, which is $5,000, and this was $1,000 higher than the ending, and we have $20,000 was collected. Put it in the formula collections, $20,000, beginning $5,000, which was $1,000 higher than ending. So the ending, which means the ending is 4, right? So the ending is 4. Sales will equal 19,000 following this formula that I highlighted in yellow color. Okay, uses of cash. Where we use cash, we have here 4 categories. You use cash for payments of accounts payable. If you have some accounts payable, you can pay it using your cash, or you pay it for labor or administrative or other expenses, or you pay it for capital expenditures. You invest it or you pay it as taxes or as interest or dividend payments. So those are the main 4 categories where you spend the cash. The cash balance. Are large cash in early periods generally a sign of trouble for the firms? No. So if we have too much cash outflow, if you spend too much cash at the beginning of when you start the company, this doesn't mean the company in trouble. This means the company, okay, they are investing, right? They are investing for a future project. So sometimes we can use something called scenario analysis. So you will have different scenarios, and for each scenario you check what will be the outcome. Here we have example. You can read it for the textbook. Source of short-term financing. Now, from where we can get short-term financing? The first and the most famous example, bank loans. You can apply for a bank loan, right? And under bank loan, we have something called lines of credit. We will explain this one later, inshallah. Actually, on each of them, we have one slide. So we have bank loans, or you apply for secured loans, or you applied for commercial paper. So these are the examples of what short-term financing. Let's start with a bank loan. This is the simplest and most common form of short-term financing. Under this one, we have something called line of credit. It is an agreement by a bank that a company may borrow at any time up to an established limit. So sometimes you have an agreement with the company. The bank will have agreement with the company. They can give them extra cash, like they can withdraw more than the amount in the account, okay, up to a specific limit if they need it. We call it line of credit. Term loans along that last for an extended period of time, more than 1 year. We call it a term loan. Self-liquidating loans, a loan that provides the cash to repay itself within the sale of the goods. So you take a loan, and this loan you are going to repay it once you sell the goods or your product. Those three are examples of what? Of bank loans. Then we have secured loans. From the name, if a bank is concerned about credit risk, it will demand that a firm provide a collateral for the loan. So if the bank is worried about your company, okay, whether you can repay the loan or not, they may ask for a collateral. We call this one secured loan. Example, accounts receivable financing. So the firm here assigns its receivable to the bank. So the firm will apply for a bank loan. They take a bank loan, and the guarantee or the collateral will be the account receivable of the company. Something happened, the bank will receive the payment from the account receivable. Inventory financing. The bank accepts the firm's inventory as a collateral. So the collateral, the guarantee, will be the inventory when you apply for that loan. The last type is called commercial paper. Large companies bypass the bank and issue commercial paper directly to large inventories. So if you need money, okay, as a company, one way to raise money, you can issue something called commercial paper. You issue to large inventories, and investors will pay you money. Okay, the questions: is commercial paper, we consider it a secured or unsecured debt? It is unsecured notes issued by the firm. Okay, now we covered short-term financing. So this is all for this chapter. Thank you so much. Assalamu alaikum wa rahmatullah wa barakatuh.